Ever wondered how to pick stocks effectively? Well, you're not alone. The world of investing can seem like a labyrinth, filled with complex terms, numerous strategies, and a multitude of stocks to choose from. But fear not, as we're here to simplify things. Today, we're delving into the realm of stock picking, focusing on two key strategies: fundamental and technical analysis. Fundamental analysis is like being a detective. It involves examining a company's business, its industry, and the broader economy to identify stocks with strong growth potential. Think of it as getting to know the company inside out. On the flip side, we have technical analysis, which is more like being a fortune teller. It bypasses the company's fundamentals and instead looks for statistical patterns on stock charts that might predict future price movements. Intrigued? Excellent! In the next few minutes, we'll delve deeper into each of these methods and how they can aid in effective stock picking. First, let's explore the fundamental analysis. This technique is akin to being a detective of the financial world. You're examining the underlying company's business, its industry, and the broader economy. You're trying to figure out if the company is strong, healthy, and positioned to grow. Imagine you're considering buying a house. You wouldn't just look at the paint color or the style of the front door. You'd look at the foundation, check the roof, the plumbing, the heating system. You'd consider the neighborhood, the local schools, the proximity to your work. This is what fundamental analysis is all about. It's about looking at the fundamentals of a company, the solid facts that tell you about its health and potential for growth. It's not just about the company's current condition, but also its future potential. It's about digging deep and understanding the company's business model, its competitive advantages, the quality of its management, and its financial health. Key metrics used in fundamental analysis include earnings per share, price-to-earnings ratio, PE growth, and dividend yield. Earnings per share, or EPS, is a measure of a company's profitability. The price-to-earnings ratio, or PE ratio, is a valuation ratio of a company's current share price compared to its per-share earnings. PE growth, or PEG, is a stock's PE ratio divided by the growth rate of its earnings. And the dividend yield is the annual dividend payment shareholders receive for each share they own, expressed as a percentage of the stock price. These metrics can give you insights into a company's performance and its potential for future growth. They can help you identify undervalued stocks with strong growth potential. But remember, fundamental analysis is not about predicting the future. It's about understanding the present in the context of the past to make informed decisions about the future. So whether you're a long-term investor or a short-term trader, fundamental analysis can provide valuable insights. It's a tool in your stock-picking tool belt, along with technical analysis, which we'll explore next. Fundamental analysis can help identify stocks with strong growth potential at a good price. And that's the end of the story. Or is it just the beginning? Let's move on to the next chapter. Next, we dive into technical analysis. Technical analysis is a fascinating world of charts, patterns, and indicators. Unlike fundamental analysis, it doesn't concern itself with the intrinsic value of a company. Instead, it focuses on the statistical patterns that emerge on stock charts. The aim? To predict future price and volume moves. Imagine a detective solving a case. They collect clues, look for patterns, and make deductions. Similarly, technical analysts examine the past performance of a stock, looking for patterns that might foretell future price movements. They believe that history tends to repeat itself, and that price movements are not entirely random. Now, you may wonder, why bypass the company's fundamentals? The answer lies in the efficient market hypothesis. This theory holds that stock prices already reflect all the publicly available information about a particular company. So, according to this school of thought, there's no real advantage in poring over a balance sheet, income statement, or other financial information. The market has already done the homework for you. Technical analysis is all about price and volume. It's like reading the pulse of the market, gauging its mood swings and momentum. It's about identifying trends and reversals, support and resistance levels, and various chart patterns. All these elements can provide clues about where the price might head next. Now, technical analysis is often used for shorter-term trades. Why? Because price patterns and trends tend to play out over weeks to months, rather than years. Think of it as a weather forecast. It can give you an idea of what to expect in the near term, but it won't tell you the climate trend for the next decade. In essence, technical analysis offers a different lens to view the stock market. It's not about finding undervalued companies or high-growth prospects, but about identifying trading opportunities based on price patterns and market psychology. Technical analysis can help predict future price moves and is often used for shorter-term trades. So, which type of analysis should you choose? Now that's a question you might be tossing around in your mind. Well, both fundamental and technical analysis have their own unique strengths and can reveal potentially valuable information about a stock. Here's a little secret: there's no rule that says you can only use one. In fact, focusing solely on one style could cause you to miss important clues about a stock's prospects. Think of it like this: if you're only looking at the road through the rearview mirror, you might miss what's up ahead. The same goes for stock analysis. Fundamental analysis gives you a good idea of where the company stands today and its potential for future growth. On the other hand, technical analysis can give you insights into trends and patterns that can help predict future price movements. Now, imagine combining these two forms of analysis. It's like having a superpower that allows you to see both the present condition and the future possibilities of a stock. It's about using the strengths of each analysis to complement the other. You could use fundamental factors to select the stock and technical factors to identify the specific entry or exit price. It's like picking the perfect fruit from a tree and knowing the exact right moment to pluck it. But remember, there's no one-size-fits-all approach to stock analysis. The type of analysis you choose depends heavily on your personal style, your investment goals, your risk tolerance, and the intended duration of your investment or trade. Some investors might prefer to stick to one type of analysis, while others might enjoy the benefits of a mixed approach. In the end, choosing the right analysis is like choosing the right tool for a job. It's about understanding what each tool can do and how it can help you achieve your investment goals. And sometimes, it might just mean using more than one tool to get the job done. Choosing the right analysis depends on your personal style and the intended duration of your investment or trade. So, take a moment to reflect on what you've learned so far, and remember, the choice is ultimately yours. Now, let's look at a growth investor's strategy. Growth investors are like explorers on a treasure hunt. They're not interested in the shiny nuggets lying on the surface. Instead, they're digging deep, looking for those hidden gems that hold promise for the future. These investors are all about future prospects. They're aiming to invest in companies that, while they may not be turning a profit today, show signs of strong revenue growth and have a high potential to do so in the future. Think of it as planting a seed. It may not look like much now, but given the right conditions, sunlight, water, fertile soil, it could grow into a mighty tree. That's how growth investors view companies. They're not overly concerned with current profits. Instead, they're looking at the company's ability to grow and generate revenue in the future. But how do they decide if a company is a good prospect for the future? They look at historical and projected revenue growth rates. They're interested in companies that have shown consistent revenue growth over time and are projected to continue that trend in the future. These investors also look for innovative companies that have a competitive edge. Perhaps they have a unique product or service, or maybe they're leading the way in a new and emerging industry. These factors could make them a good prospect for the future. Growth investing involves focusing on a company's potential for future revenue growth. Lastly, we'll explore a value investor's strategy. Unlike growth investors who chase future prospects, value investors are like detectives, seeking clues in the present. They focus on whether the current stock price makes sense given the health of a company. They're not swayed by flashy growth prospects or innovative products. Instead, they're the ones poring over balance sheets, hunting for evidence that a company's stock is undervalued. Value investors seek companies that appear to be priced below what their revenues, earnings per share, or other fundamental metrics suggest. They're looking for diamonds in the rough, stocks that the market has overlooked or undervalued. And when they find these hidden treasures, they can often buy them at a bargain price. Their sights are often set on industry-leading companies. These are companies that may be past their peak revenue growth years, but they're steady performers, often paying consistent dividends. These are the stocks that value investors love. They tend to have low price-to-earnings ratios and pay above-average dividends, but they trade at a price that is very low or even below their book value, which is the total tangible assets minus total liabilities. In essence, value investing is like shopping for antiques. It's about finding high-quality items at a good price, not simply buying cheap stocks. It's about investing in great companies at a good price, not just because they're cheap. Value investing involves focusing on industry-leading companies that are priced below their book value. So what have we learned today? We've journeyed through the intriguing world of stock-picking strategies, exploring both fundamental and technical analysis. We've seen how fundamental analysis seeks value in the underlying business, its industry, and the broader economy, using metrics like earnings per share and price-to-earnings ratio. On the flip side, technical analysis looks for statistical patterns on stock charts, focusing on price and volume moves. We've also delved into the strategies of growth and value investors. Growth investors bet on the future prospects of a company, focusing on metrics like historical and projected revenue growth rates. Value investors, however, seek companies priced below their worth, often focusing on industry-leading companies that pay steady dividends. Finally, we've pondered on the idea of using both forms of analysis together, playing to their strengths and complementing each other. Remember, picking stocks effectively involves carefully analyzing a company's fundamentals, studying stock charts, and being aware of your personal investment style and goals. Happy investing!